For more, we want to bring in CNBC's senior economics reporter Steve Leisman and John Ryding, the chief economic advisor at Brean Capital. Steve, you go first. What do you see in the numbers besides what Rick just told us?
This is now the most important Philly Fed index ever issued, right? Because it's all we got. Right. And I do want to say a little bit more detail here. The prices paid index did go up 49.2 versus 46.8, but the outlook is actually a little bit better. The 6-month business outlook, 6-month capital expenditures outlook, both improved and at pretty decent numbers there. So you don't know if because things are so bad, people think they have to get better, or people legitimately think things will get better. We're going to want to just follow that because it's a pretty good outlook. Whereas the current assessment of the current situation, which is the data Rick correctly gave us, I do want to do one thing, which Troy Ludka from SMBC, Nico, who works with Joe Livornia before he went to Treasury, did a clever thing. It's clever because I thought of it a long time ago and never could do it, but he did it. What he did is he took all of these Fed surveys that we talk about, and he took the 5 that have employment and price indices, and he put them all together, and hopefully we have that chart, which shows us what's going on with employment and prices at these each of these different surveys. And now zero in, folks, if you could, on the right side. What does it tell you? Prices are higher, employment is flat. So this really confirms, this is September data.
It goes all the way back to 2000?
You have to do that because you want to see how it tracks, right? You want to see how the two work together. And overall, I'm not showing you these graphs. The blue line tracks inflation very well. Mm-hmm. The orange line, employment, it's so volatile. Directionally, it goes in the right direction when you total the 5 of them up, but it doesn't work on a month-to-month basis quite so well. You can see employment's flat from these 5 surveys, and that prices are generally elevated, though not as elevated as they were during the pandemic. It's as good a contemporary, what do you want to say, aggregation of these surveys that's out there. They're out there talking to businesses, getting responses from the 5 different Fed banks that do this, and it's a proxy. It's another proxy, and I think it's a proxy that the Fed is looking at and is helping inform their decisions now.
Okay, John Ryding, I want to ask you about that gap between the orange line and the blue line that we were just saying. That kind of matches up with what Jay Powell has said recently, that basically the balance of concern is probably falling to the jobs, to the employment side of the mandate at this point, less so on prices. Is that what you think is the case, and is that what maybe Fed Chairman Powell is looking at?
It's not what I think is the case, actually. I mean, Chair Powell has said, we're in a difficult situation where the price stability mandate and the employment mandate are at odds with each other. And the Fed has said, without specifying any details in the past, the leg of the mandate that is further away from our objective is the one we will focus on. So inflation is close to 3%. These indicators, both from the New York Fed and what you're reading here, aren't showing very encouraging signs that we're going to be trending back to the 2% inflation target. And in the economy, the unemployment rate is 1/10 of a point above what the Fed thinks is full employment. So this whole idea that the balance of risks has switched to the labor market, the argument to me is very contorted. And the Fed, these surveys are good, but to be honest, we kind of ignored them when we had real data. So they haven't gotten any better. It's not like they say in the land of the blind, the one-eyed man is king. This is a case of the one-eyed man with the cataracts is king. It really doesn't track very well.
I want to emphasize what John is saying. You had Bowman the other day saying we're headed back to 2%. You've had Myron saying there is no inflation from tariffs. It's a bit of kind of wishful thinking out there.
It's very wishful thinking. We have to think back. Back in 2021, when the Fed was maybe more of a coherent entity, they went through the whole inflation is transitory routine, which turned out simply not to be true. So we're in a situation where we seem to be headed headlong. Market surprised, and last time I looked, 98% chance of a rate cut on October 29th, headlong into easing policy while inflation is headed in the wrong direction. The Fed tells us inflation expectations are anchored, but the University of Michigan survey, another indicator that we get, It says the 5-year expected inflation rate's 3.7%, which is nearly double the Fed's official target. So I do not get why the focus, well, I mean, I kind of do, but we probably won't talk about that, why the focus is on cutting rates to address labor market weakness, which, by the way, is what the Fed did for 100 basis points between September and December of last year. They took out insurance at that time for a potential weakening in the labor market.
It's the best way to not worry about your blood pressure.
Is what?
Don't measure it.
Don't measure it. But unfortunately, it's a silent killer, and so is inflation. And you don't want. But here's the one thing. Am I wrong that we hear again and again that now, Jay Powell, we're just matching firings and hirings, and we're at this static level. No one can ask for really a wage increase. So if you get the one-time tariff bump, you don't get that wage price spiral.
Let me make that more technical than what you're saying.
But the weaker job market will bring inflation with housing. Right. With the housing shelter costs coming down, we'll get to 2. We're drifting to 2, John.
This is Waller's idea. This is Myron's idea that there is not a route for inflation to create, for the job market to create the inflation from the tariffs that would be broader.
But we know the Phillips curve doesn't work. Inflation is not a labor market phenomenon. Inflation is a monetary phenomenon. And that was something that Milton Friedman made clear back in his 1968 American Economic Association address. And Joe, to your point on the labor market, yes, hiring is moribund and firing is very low. But we're seeing studies come out that say one of the things that's holding down hiring is AI, and it's substituting for those entry-level jobs. It's not a shortage of demand. So what do interest rate cuts do? They lower the cost of capital and increase the incentive to invest.
But couldn't AI be deflationary, the biggest deflationary force we've ever seen?
After it's inflationary. After all of it. But look, it's not fair, because my friend Rick Santelli has been steadfast on this issue that the Fed is ignoring inflation, and I think he gets the last word, Rick.
You should move.
We have to go to break, but
if you want to get in all the time, you need to move to New York.
Rick has been steadfast on this.
We got a great new mayor coming.
He's been hard money the whole time.
That's right. And listen, I remember John Ryding when he was at Bear Stearns. He's also a hard money guy. He's been spouting good economics for decades, and I agree with him on pretty much every score there. Inflation is being ignored. The labor market signals are questionable in terms of the extent of the weakness. So my final question is, why are they going to ease 2 times, and why is the market happy with that? That part's easy. Market's always happy with lower rates. But in the end, I don't see a catalyst for doing it. John Ryding, you get an A+.